Jai Hind to all and welcome to this video lecture on tax planning and management. The content of this lecture is related to unit number 3 and the contents are tax planning, tax evasion, tax avoidance and advanced tax. The first point of discussion is tax planning. What is tax planning and how it is done? Tax planning may be defined as arrangement of one's financial affairs to take full advantage of all eligible tax exemptions, deductions, concessions, rebates, allowances permitted under Income Tax Act. So the tax burden is minimized in the hands of taxpayer without violating the legal provision. It means if you are proactive, if you are doing well, that means you are collecting the documents, you are planning in the beginning of the financial year, you can reduce lots of tax, can reduce your tax bill, reduce your tax liability, and these savings in the tax is legal. Legally, you can save lots of tax. But yes, obviously, a planning from the initial days is required. Tax planning is legal, as I have already said. It is a legal thing. Tax planning can be done by every person. Every person means it can be done by individual, or it can be done by company or any other legal person. For example, like in case of individual, there are so many provisions, so many sections under which you can save the amount, or you can invest the amount, or by complying certain conditions you can save a lot. For example, if you are investing in the specific investments or specific avenues of the investment, then you can claim the deduction under 80C. Maximum deduction under 80C is 1,50,000 rupees. That means the amount invested in the specified saving schemes or 1,50,000, whichever is lower. It means if you plan well and from the starting of your financial year, if you save certain amount, that is the cash saving obviously, and you invest it in the specified scheme, obviously up to 1,50,000 rupees can be reduced from your gross total income. That is a huge saving. For example, your tax slab is 30%, right? 30% tax slab for payment of tax, and you save, suppose 1,50,000, you avail maximum of section 80C. So 30% of the 1,50,000, that means 45,000 rupees you can save just by doing investment as an individual. Section 80C is also applicable in case of HUF, that is Hindu Undivided Family. Now, what are different investment schemes or options which in which you can invest and claim the deduction under Section 80C? These are like investment in PPF, Public Provident Fund, investment in RPF, Recognized Provident Fund, investment in SPF, purchase of NSC, then certain mutual funds, payment of tuition fee up to maximum of 2 children, tuition fee is allowed, payment of principal amount of home loan, then it comes national pension scheme, certain mutual funds. These things will save a lot just because of investment. Another example is like next example I have taken for the corporate SSC. Suppose you are a company, you are a corporate SSC and you want to save tax. So there are so many provisions, so many sections. For example, under section 10A, if you are a corporate SSC and your location of your factory, location of your company is in SEZ, Special Economic Zone, then you can happily enjoy the tax holiday up to 15 years, 10 to 15 years for tax exemption. It means if the company is located in SEZ, first 5 year of the production or the commencement of the business, there is no tax liability. That means up to 5 years, the company is not liable to pay any tax. The full exemption is there. In next 5 years, 50% of the tax will be allowed as deduction. That means you are liable for 50% of the tax only. And next 5 years. That means 5 plus 5 plus 5. Maximum is 15 years. Next 5 year, again you can claim 50% of the deduction under section 10A, but you have to reinvest your profit within your business, and you have to comply with certain conditions. That means there is a tax holiday of 15 years for a company. Now assume see that situation. Visualize that situation that you are a new company and you are not required to pay any income tax up to 15 years. That is a very happy thing for you. And you can become established company then. The tax rate for the company is 30%. So saving of 30% of the profit up to maximum 15 years. That is a huge saving. And it can be done by way of tax planning. Okay. So these are few examples which I have taken for individual, for HUF and for corporate. See, this is very basic example, and there are not many examples for the tax planning. Tax planning is a legal thing. You can save just because of investment, just because of location, just because of the product, nature of product or services. There are many things. So it is my advice that before calculating your tax liability, you must have proper knowledge of tax planning so that the tax liability can be reduced. The next point is tax avoidance. Tax avoidance is it is not illegal. It is also a legal way, but it is not ethical even. It is legal, but it is not ethical. Tax avoidance basically means making use of loopholes in the tax law. That means there is always a loophole in the tax law. It is written by some committee, it is approved by parliament, but because the law is so huge, each and every condition, each and every situations cannot be considered in the law, and there must be some loopholes. There are certain persons who are able to find out the loopholes of the tax law, and they are taking benefit of that. So if you are taking the benefit of the loopholes, the problems, it can be interpretation problem of the tax law. So it is not illegal because nobody can prove it that it is not legal, right? It is legal, but it is not ethical. Although tax avoidance is 100% legal, it is not advisable for taxpayer as defeated in the intention of lawmaker and use of this to his own advantage. Suppose if you are taking the benefit of tax avoidance, there are some loopholes, some problem in the tax, and you are taking benefit of the doubt and you take the advantage, right? So if further in case of assessment, when you file ITR and then it will be assessed by the income tax officer and they got to know that okay, you are taking advantage of this loophole, then case maybe go to the appellate tribunal or high court or supreme court. Then there is a possibility then high court or supreme court will decide against you. In that situation you have to pay tax along with the interest and the penalties. So it is not advisable. Yes, it is there, but it is not advisable. Both tax planning and tax avoidance are legal ways to reduce tax. There is only a thin line of difference between tax planning and tax avoidance. Tax planning, a taxpayer is doing what the government wants to do. That means government has a specified clear provision that yes, go for the tax planning, you should do it. But in case of tax avoidance, a taxpayer is doing something which the government didn't expect that a taxpayer to do so. That means in case of tax avoidance, that is not a happy situation for the government. Because of benefit of doubt, you can take it, but government is not happy to do. You are defeating the basic intention of the law. Government is trying very hard to remove all the loopholes and brings regular amendment in the budget. That's why if there is any case of tax avoidance and government know that yes, there is loophole, then every time there is an amendment in the tax provision tax act, and these amendments are given in the budget, so as to ensure that people don't avoid tax by manipulating the law. It is manipulation of the law. With regular amendment by being introduced in the tax budget by the government, it is very difficult for a person to do tax avoidance. Government is trying very hard, and other persons are also trying very hard to get the loopholes. That is a task for the persons, for the SSE who are trying to make the benefit of the loopholes. So this is the legal one. I'm saying this is legal? Because it is very hard for the government to prove it that it is illegal. You can say that yes, it is given in the law, how it is illegal. नेक्स्ट इज टैक्स एवेजन. टैक्स एवेजन को हम हिंदी में टैक्स चोरी भी कहते हैं. टैक्स एवेजन involve breaking of law, not paying one's taxes where the law clearly state that they must be paid. That means you know that tax is payable, laws are there, clear provisions are there, but still you are not doing so. So it is illegal, it is cheating by clearly knowing that intentionally you are not following the law, you are not paying the tax. That is tax evasion. Tax evasion is a method which a person illegally reduce his tax burden either by deflecting their income or inflating their expenses. The more and more expenses bills you are submitting to the income tax officer and claiming that yes, these are the expenses, they are bogus bills maybe, and by submitting bogus bills you just wanted to reduce your income, and with that you want to reduce your tax liability. Both deflating of income and inflating of expense have the same impact on the profit get reduced. As a result, the tax burden also get reduced. But as I have already said that tax evasion is illegal, right? And if ITO found it that yes, there is evasion, then huge penalties are there, interest are there, right? It may be possible that you heard the word search and seizure when the tax raid is there, right? Income tax raid is there. Search and seizure method are followed by the income tax authority to search the cases of tax evasion if they have any information or doubt. Okay. Now in India, people usually evade their tax by dealing in cash without disclosing the income, without disclosing the same the books of account. That is the general method. That means you are bypassing the banking system, and you are not making entries in the bank. You are doing the transaction in cash, and you are not disclosing the transaction. You are making cash sales and not entering the sales into books of accounts. That is the general way of tax evasion in India. To ensure that taxpayer don't evade the tax, government has a visual eye on almost all the transactions, and income tax notices are being issued in case of discrepancies is expected in the tax that should have been paid and tax that actually have been paid by the taxpayer. After lots of scrutiny of income tax returns, income tax authority have their own tools and methods for collecting the information related to tax evasions, right? And if they found, then heavy penalties are levied on the cases. Now the next point of discussion is advance tax. What is advance tax? Advance tax means what is the normal rule of payment of tax? The rule says that in the year, that means in the previous year, you will earn, and in the assessment year you will pay the tax. That means 1 year you will be earning and next year you will be paying tax. But advance tax is saying something else. It says that if the person having estimated tax liability of rupees 10,000 or more in a year, this tax liability is obviously estimated one. It is not an actual tax liability. It is an estimation, forecast. In a year, then you are required to pay advance tax. Here, this provision is for each and every person. That means for individual, HUF, cooperative society, artificial judicial person, corporate, SC, partnership firm, for every person. If the tax liability is more than 10,000, then the person is required to pay advance tax. This payment of tax in advance and in installment is known as advance tax payment. Under section 208 is dealing with the advance tax provisions. Income tax act deals with the advance tax payment, and section 234C, it is related to interest of the advance tax, deals with the delay in the remittance of advance tax payment. That means there may be, you can say, what are the lackings, you are not able to pay advance tax, or the installment of advance tax is less than what is required. Advance tax is paid before the completion of financial year. as I have already told, that advance tax is paid during the year of earning, right? It is not paid in the year of assessment year. It is paid in financial year or previous year. Who should remit advance tax payment? As I have already discussed, that each and every person, for example, individual, company, limited liability partnership, trust, corporate, non-corporate, everybody, who has estimated tax liability for more than 10,000 in a year, have to pay advance tax as per the provisions under section 208. Only senior citizen, that means an individual over 60 years of age, not having income from business or profession, is exempted from making advance tax payment. Senior citizen or super senior citizens are not required to pay advance tax if they don't have any PGBP income. Now, what are the due date? How to calculate the installments of the advance tax? All the assessees are required to pay 4 installments of the advance tax, that is by 15th of June, this is the first installment, by 15th of September, second installment, 15th December, third installment, and by 15th of March, fourth installment. And till 31st March, any payment till 31st March of the financial year, that is a previous year, will be considered under advance tax. So what will be the amount, how to calculate installment? These are the due date and how to calculate the installment of the advance tax. It is for all type of taxpayer, that is other than those opted for presumptive taxation scheme. If you are opted for presumptive taxation scheme under section 44 AD AEAF, then these dates are not applicable on you. We have separate scheme for them. So if you are a taxpayer not coming under section 44 AD then up to 15th of June, by 15th of June, up to 15% of the tax, total tax calculated by the assessee should be paid as an advance tax. These taxes are calculated on estimation basis, obviously. Till 15th of June, you have to calculate full tax liability throughout the year. And then 15% of the advance tax calculated by you must be paid before 15th June. Again, by 15th of September, you have to repeat these steps again. You are required to calculate full yearly tax liability for the SEC, and 45% of advance tax, up to 45% of the advance tax must be paid before 15th of September. It means in the second installment, 15% you have already paid in the first installment. Up to 45% of advance tax is paid till 15th of September. It means the difference of these two, that means 30% will be paid as second installment if there is not any change. If it is changed, then calculation will be done accordingly. By 15th of December, up to 75% of advance tax must be paid by the SSA. Then up to 75%, what it means? That 45% already paid as second installment. So by 15th of December, the difference between these two is 30% of the advance tax. So third installment will be 30%. So how to calculate the installments? Up to first installment will be 15%, second installment will be 30%, third installment will be 30%, and rest 30, 30, 45. कितना हो गया? 60 plus 70, 75, and rest remaining 25% will be paid before 15th of March. That will become your fourth installment. If the taxpayer has opted for presumption scheme 44 AD AEAF, in that situation, he has to pay 100% of the advance tax by 15th of March. There is no installment. Installment system is not there. Now, how to calculate the self-assessment and payment of advance tax, how to self-assess the amount of advance tax. All taxpayers having estimated tax liability over 10,000 must first estimate current income and calculate the advance tax payable. I'm again saying again and again that it is an estimated one. As the time passes, if you have any further information, there is any change in the profit or sales or revenue, whatever it is, then you have to recalculate it again. The tax can be computed on the current income estimated by the taxpayer at the rate in force during financial year. The rates will be as applicable on the particular financial year. From the tax so computed, tax deducted or collected at source, that means TDS or TCS, will be deducted and the balance tax will be used as to compute the advance tax liability. Suppose your tax liability is 50,000 and you have already TDS, right, tax collected, tax deducted at source up to suppose 15,000. So balance will be taken as tax liability for advance tax. Also, the relief of tax allowed under Section 90 or 90A or any deduction under Section 91 or any tax credit allowed to be set off as per Section 115 JAA, that is related to MAT tax liability, MAT, minimum alternative tax. Section 115 GD shall also be deducted while computing the advance tax liability. Here I have an example for you. For example, if the taxpayer has an estimated tax liability of 1 lakh rupee, this is the tax payment required, after considering all the eligible deduction and TDS deduction, then the advance tax payment would be, how to calculate installment obviously. The first installment will be 15% of 1 lakh, that is 15,000, and it should be paid before 15th of June. Next installment will be maximum how much amount is required, 45,000 to be paid before 15th of September. But as you already paid 15,000 rupees in first installment, so the balance, that means 30,000 rupees, will be payable as second installment on or before 15th of September. For third installment, up to 75% of total tax liability should be paid, right, before 15th of December. So what is the actual payment? The total tax payment requirement is 75,000, but you have already paid 15 as first installment and 45 and 30,000 as in the second installment. That means 45,000 rupees is already paid. You will reduce this 45,000 rupees from 75 and then balance 30,000 rupees will be payable as third installment on or before 15th December. And the final tax liability will be 1 lakh rupee. 75,000 is already paid. So the rest 25,000 will be paid as fourth installment on or before 15th March. That's all for advance tax. In the next lecture, we will discuss about tax deduction and source and some remaining topics. Thank you so much.